Hello, my name is Ellen Correa-Golay, and I manage the Treasury Trading Desk at the Federal Reserve Bank of New York. On behalf of the Money Marketeers, I would like to welcome you all to today's event featuring Dr. Mary Daly, the President and CEO of the Federal Reserve Bank of San Francisco. The Money Marketeers of NYU is a nonprofit organization founded to enhance knowledge and understanding of the financial marketplace and to promote higher education and finance through scholarships to NYU's Stern School of Business. We are thrilled to host President Daly's speech today. Mary Daly has served as the President and CEO of the Federal Reserve Bank of San Francisco since 2018, and through that role, she is a participant in the Federal Open Market Committee and helps set monetary policy that promotes a healthy and stable economy. As President of the San Francisco Fed, Dr. Daly has pushed forward initiatives to make that institution a more transparent and community-engaged bank. Prior to being named the San Francisco Fed president, Dr. Daly worked as an economist at the San Francisco Fed for many years, ultimately becoming the director of research. President Daly's topic today is financial stability and monetary policy, a topic that could not be more timely given the events of 2020. Please join me in welcoming President Daly.
Thank you, Ellen. Thank you so much for that introduction. And I am just delighted to be here, actually. So let me start with a story. I grew up in Missouri and I was surrounded by three rivers. Really, it was a floodplain. And nearly every spring, at least one of those rivers would flood. And each time this happened, families, businesses, and sometimes entire communities would be forced to higher ground until the water receded and returned to its banks. And every time it happened, public programs were there to assist. Teams helped people evacuate, temporary shelters were stood up overnight, and financial support was provided for repairs and rebuilding. And so by many measures, these responses, the entire way it was handled, was a win. Repeated successes of a system meant to ensure against these very types of disasters. The problem was flooding was not a rare event. It happened almost every year. And against that backdrop, the public policy seemed incomplete. A patch against a problem that owed in part to known structural factors, such as geography, location, and regular weather patterns. And all of this takes me to what I'd like to talk about today. Changes in our economic and financial landscape have left us with a financial market infrastructure, a way of being that is more vulnerable to disruptions. And we saw this in the global financial crisis and very much in our recent experience with the unprecedented shock of COVID-19. As the lender of last resort in the United States, the Federal Reserve was there to assist. In both cases, we intervened quickly, provided liquidity, stabilized markets, and ensured that the financial system could continue to fulfill its vital role in helping the economy. But the frequency and scale of our interventions is concerning. Without changes to our financial infrastructure, the Federal Reserve may need to be regular rescuers, if you will, asked to step in and stabilize markets during periods of turbulence. And not just for 100-year floods like COVID-19, but for more typical disruptions associated with average shocks to the global and domestic economy. Now, the Federal Reserve's role as lender of last resort is critical and will always be important. It's a backstop and it protects against turmoil and dislocation caused by unforeseen and extreme events. But to fulfill the role sustainably, we need to be the last, not the first, line of defense. Regularly relying on save-the-day interventions by the Federal Reserve has costs, public losses, and undesirable risk-taking on the part of the private sector. So as policymakers, we must evaluate our actions. We must use all of our experiences, even those in times of crisis, to identify vulnerabilities and create a more resilient future. And this will mean working together across regulatory agencies to examine the events of last year and ask what else needs to be done to minimize the chances of future severe disruptions. As we begin to emerge from our battles against COVID-19, it is a very good time to focus on this, crafting more complete policies that leave us better prepared to weather future storms large and small. Before I dig in though, let me remind you that the remarks I'm making today are my own and don't necessarily reflect the views of anyone else within the Federal Reserve System. So I don't have to tell you this, but I will anyway. The financial sector is crucial for the smooth functioning of the economy. It enables the borrowing, lending, and saving that supports growth. And from that vantage point, if you think about it, it is a public resource, a critical part of our infrastructure that contributes to our shared prosperity. But many shifts, exogenous, completely exogenous to the financial system itself, are affecting its functioning. Most notable is the decline in the neutral rate of interest, or R star as we like to call it, which has been falling globally for the past 3 decades. The decline reflects slow-moving structural trends, again exogenous, including a step down in productivity growth and shifts in just the demand for savings and investment that's associated with global population aging. And this decline in R star, along with the decline in other prevailing interest rates, by themselves would challenge the profitability of financial firms. It would change it. But lower neutral rates of interest also mean that the Federal Reserve and other central banks, constrained by the effective lower bound on interest rates, need to employ low for long policies in order to achieve mandated employment and price stability goals. And the effects of these low for long policies have well-documented benefits, boosting economic growth, which ultimately supports the financial system. But like anything, they are not without trade-offs. And over time, low interest rates can put pressure on the business models of financial institutions, leading them to reach for yield, which can of course jeopardize the stability of the entire financial system. Now, a related but different and additional development affecting the financial system is the broad-based increase in debt levels and leverage ratios. Government policies enacted to offset some of the worst aspects of the global financial crisis in the late 2000s left many advanced nations with relatively high debt to GDP. And the response to the COVID-19 pandemic has only intensified this trend. But debt has also surged in the private sector, especially among non-financial corporate firms. And notably, a good deal of this increase has been funded outside of the banking sector. While the rise in public and private debt have contributed to economic growth over the past decade, and that's really without argument, the increased indebtedness creates vulnerabilities for the financial system, which then the financial system has to intermediate. And importantly, as we've seen, this has had a significant impact on the US Treasury market. And this is the final aspect of the changed landscape that I'll focus on. The Treasury market is the largest and most liquid bond market in the world, and it's nothing less than a critical component of the domestic and global financial infrastructure, important here in our own shores and across the globe. Broker-dealers, of course, provide the lion's share of Treasury security intermediation and are generally, and I'd say generally, very well positioned to meet the demands of investors to buy and sell Treasury securities. Over the past decade, Treasury securities have also become an increasingly important part of short-term funding markets, for instance, as collateral in repurchase agreements. And a sizable and growing share of these securities are being held by financial entities which look different from previous holders, including hedge funds and money market funds, that in times of stress can find themselves needing to liquidate quickly to meet redemption demand. And this can put pressure on broker-dealers in a way that has been different than in the past to absorb those sales. And of course, all of this gets magnified when we remember that the Treasury market is a safe haven for foreign official and private investors. And normally this safe haven characteristic is a benefit to the US economy. But in periods of global stress, when liquidity is at a premium, it increases the demands on Treasury clearing that make those demands go far beyond the needs of just domestic investors. And again, in all of these situations, broker-dealers are the primary intermediary tasked with meeting the demand for this liquidity. And this normally works well, as I said. But as we saw in the last year, these intermediaries face regulatory and internal risk limits that can challenge their ability to meet surges in demand, especially in these times, these periods of stress. And given the growing size of the Treasury market and the potential inability of broker-dealer balance sheets to just keep up with that size, this intermediation channel could face more capacity pressure in the future. And this makes it even more important that we look at the events of COVID. The onset of COVID-19 and the financial and economic disruptions that it caused, they just exacerbated so many of the vulnerabilities that were embedded in the changed financial landscape I just spoke about. Of course, the crisis roiled financial markets. Even the bedrock Treasury market experienced a severe disruption. In the early days of March 2020, and I'm sure each and every one of you remember them, when it became clear that COVID-19 was a pandemic that was going to disrupt the entire global economy, investor sentiment shifted very quickly. Short-term funding markets became especially stressed. This dash for cash, as we call it, among both domestic and foreign investors, resulted in a run from even relatively safe, longer-dated Treasury securities, as literally everyone headed for cash and Treasury bills. The rapid and large-scale repositioning caused trading volumes to surge and price volatility to spike. Broker-dealers facing their own internal risk and balance sheet limits had difficulty meeting the demand. Bid-ask spreads widened, market depth fell, and the normally quite fluid Treasury market was strained. And stress was particularly important or apparent in this longer-dated off-the-run securities. Why do I review all these things you know? Well, largely to say the Federal Reserve and the reserve system and the New York Fed's market desk reacted immediately, conducting record numbers of open market operations to restore and promote smooth market functioning. And this is exactly what the lender of last resort is tasked with accomplishing. So we had a crisis and there was a response. But if we step back from the crisis and the unique features of this COVID shock, the events of last March raised questions about the resiliency of intermediation in the Treasury market during periods of stress. A key lesson I remember from the global financial crisis was that even rare events deliver important messages, important things that we can pull forward. And following the GFC, regulatory bodies took those lessons and across the globe made material changes to the financial system that actually paid great dividends during the COVID-19 crisis. In the United States, the regulatory framework that came out of the Dodd-Frank Act actually was really supportive for our important, systemically important institutions as they entered the pandemic, giving them sufficient capital to facilitate the kind of forbearance and lending that has been very critical to our recovery. So the question before us now is, what can we learn from the events of March 2020? And how can we use those lessons to build a more resilient financial system for that future? And there are many topics we could study, but I will focus on two that are particularly salient to making sure that the system looks different next time: short-term funding markets and expanded prudential oversight. So for the Treasury market, a number of possible reforms are being discussed. These include the Federal Reserve creating a domestic standing repurchase facility to backstop markets in times of stress, and making permanent the temporary FEMA, the Foreign and International Monetary Authority's repo facility, another reminder of why we have acronyms, to help support smooth market functioning. These actions would provide assurance to markets that liquidity will be available in times of stress, in part reducing the chance and the severity of liquidity events. So the very existence reduces the chance and the severity. But they could also leave financial markets more dependent on their existence. So it's not an easy answer. We need further careful study to think about the cost and the benefits of those things. Outside of the Federal Reserve, expanding the trading platform, giving more access to more entities, and using central clearing for Treasury cash markets could reduce the burden on broker-dealers and lessen the liquidity crunch in times of stress. And reconsidering the inclusion of reserves or even treasuries in the regulatory leverage ratio requirements for broker-dealers particularly again when markets are strained, could further facilitate capacity for clearing. And again, I'll just underline that all of these changes have potential benefits and costs, so further careful study is warranted. If we turn away from the Treasury market specifically and look beyond it, the stability of hedge funds and money market funds is also an important priority. These entities have structural funding risk that can easily spike in times of stress, contributing to the severity of runs. The Financial Stability Oversight Council and the SEC have signaled movement on shoring up the resiliency of these funds, something I personally see as critical to ensuring that we are prepared for the next stressful shock. But simply fixing the Treasury market and reforming other short-term funding markets will just be one piece of ensuring a healthy financial system for the future. The proximity of the effective lower bound on interest rates and the necessity to keep policy rates lower for longer after a downturn can, as I mentioned earlier, result in reach for yield behavior among financial firms. So we will also need to find ways to foster and maintain sustainable increases in leverage. Regulators have a variety of tools that provide an effective first line of defense, including capital requirements, leverage ratios, and stress tests. And these tools have proven successful at keeping the banking sector healthy and well capitalized over the business cycle. A characteristic, as I mentioned, that has served us quite well as we've worked through the pandemic. But new risks emerge as the economy evolves, and we need to ensure that we are prepared for what those risks will bring us and what is ahead. And this is where it's important to remember, and many have said, that the banking sector is just one part of the financial system. Shadow banking was a problem during the global financial crisis. And with the rapid growth of the fintech sector, there is much to consider outside of traditional areas of banking. So at the Federal Reserve, we just take a very broad approach. We continuously monitor the resilience and vulnerabilities of the entire financial system and publish our analysis in our Financial Stability Report. And FSOC is actively working to ensure that all the regulatory bodies are coordinating across groups so that we have the right policy levers and they can be activated when they are needed. But more will likely need to be done to ensure that other parts of the financial infrastructure remain sound and stable. So I want to turn back to where I started. I often think of my own experience growing up near a floodplain. I refer back to it. The frequent disruptions of rivers to people's lives and livelihoods. It reminds me of the importance of having a strong last resort backstop. Protection against losses and events too big for any one of us to bear. But the experience also taught me the value of prevention, of building resiliency and minimizing the chances that a backstop is needed at all. And what the rivers of my youth really taught me is that optimal public policies are those that both manage and mitigate risks. Backstops and prevention that result in consistently better outcomes. And I will offer that this is the very balance we will need to strike to ensure that our ever-changing financial system continues to fulfill its role as critical public infrastructure. Thank you.
Great. Thank you so much, President Daly, for that fascinating speech. We'll now open the event up to questions from the audience. You can enter any questions you have in the question box in your sidebar. Before we start the Q&A, I wanted to mention that the views that I'll express in the Q&A are also my own and do not necessarily represent those of the Federal Reserve Bank of New York or the Federal Reserve System.
The standard.
So now, yes, exactly. Have to follow the rules very carefully. So with that out of the way, we'll turn to our first question. So in your speech, you just described that both backstops and prevention can help limit bad outcomes, like what we've seen recently. Of the two, looking at both monetary policy backstops and macroprudential policies, which do you think best address the risks of financial stability?
So this is a good question. It gets asked of me a lot. And my first thing that I always say when I start is that monetary policy is a very blunt tool. And we already have two important goals that are mandated by Congress: full employment and price stability. So we can't use monetary policy for everything because it's blunt. It's not a surgical instrument. And there are trade-offs embedded in using it for one thing when we have to let go of other things. So I would say that we really want to shore up our macroprudential, microprudential, all policies, all the things that ensure that the financial system is as sturdy and stable and resilient as it can possibly be. And use monetary policy not to ensure that that happens, but use other policies. And then, of course, we have our lender of last resort backstop responsibilities that can come in when, after all of that good work on the Prudential side, we still need a financial backstop so that we can have liquidity and we can have a functioning financial system. So monetary policy for financial stability is a second best, in my opinion.
All right, thank you for that answer. So switching gears a bit, maybe away from financial stability and more to the committee's recent policy actions. The committee has said that it plans to continue asset purchases until substantial further progress has been made to the committee's employment and inflation goals. What does substantial further progress mean to you?
So when you think about substantial further progress, it really means that we need to see things that are moving us toward the goals that we have of full employment and price stability. And I find it very useful to remind us all that we're not there yet. That if you think about the almost 9 million people who are out on the sidelines who had jobs before COVID and don't have them now, that's pretty far away from substantial further progress. And if you think of inflation as only projected to come temporarily above our 2% target and not actually hit sustainably this average inflation of 2% that we've said we need to ensure price stability, then we're far away from that target as well. So substantial further progress is giving all of us, households, marketplaces, businesses, the clarity of we need to get closer to our goals, and we need to see that we're well on our way to being able to achieve those goals before we say that it's time to start thinking about any kind of withdrawal of accommodation.
Great, thank you. Another question that came in, looking further down the road, how are you thinking about sequencing the increasing of the federal funds target range and reducing the summer portfolio? In the last crisis, the target range was increased before the portfolio runoff began. Are you anticipating a similar order of events this time around?
Well, here I'm not going to front run the committee discussions that we're certainly would be having at some point as the time for that nears. I will use this opportunity to remind everybody we're not to that time yet. We need to make substantial further progress before we think of any of this, and we need to achieve our dual mandate goals, as we said in our September statement. We're eliminating the employment shortfalls and hitting 2% and being forecast to go above 2% for a sustained period of time on inflation. So, but when I think about that, what I would like to do is broaden the conversation a bit and not make it about the, which sequencing, but rather this is all part of one set of tools. You can stack rank those tools. I do stack rank those tools in what I think we know historically has the greatest impact, and I put the funds rate adjustments, forward guidance, and then asset purchases in that order. But I think you should think of them, and I think of them as a composite. It's a way for us to provide accommodation to the economy that supports the achievement of our dual mandate goals that we've been given. And we need to use those things because of our regular constraints of the effective lower bound. In our case, in the United States, the zero lower bound. So I think of this as part of our ongoing toolkit. We will obviously discuss what the right approach to normalization is when we get to a point where normalization is appropriate to discuss. We're not there yet, but I think particular sequences aren't as important as clear and transparent communication, which I feel assured you will have and we will give as we move closer to those times.
Thank you very much. Pivoting a bit to look at inflation, if we do have overheating and inflation were to overshoot the Fed's target meaningfully, what would be the implications for financial stability?
So we're so far away from that scenario. I just want to underscore. I mean, we are really, I'll take this moment to say we're really in a space because of the low neutral rate of interest, the constraints of central banks, of the effective lower bound, and just the general, even for a normal shock, you have these constraints. So for a shock the size of COVID, this is just a lot of work that has to be done to return countries and economies to price stability and full employment. So when we think of those things, I think of this as you certainly theoretically can think of overheating and inflation rising more quickly than we would like, but I don't see it as even in the relative probability space that keeps me up at night. So with that in mind, though, what would we do? Well, I think of it as before it ever got to the point where it affects financial stability, we know that stable prices are important, and having inflation that's on average 2% is an important goal. And we are dedicated in our framework. We announced this. We're dedicated to ensuring we achieve that on either side of the goal. If inflation's too low, we're going to boost it. If inflation's too high, we're going to pull it back like we have historically have, at the same time that we're watching to ensure that employment shortfalls are removed. So those are the scenarios that I think span the history, our recent history, and the ones that are projected to span our future history. And so those are the ones I'm focused on. The great reminder to everyone is we have the tools to pull inflation back. We don't have constraints there. Our constraints are getting inflation up and eliminating the employment shortfalls.
Thank you. So speaking of employment shortfalls, we received a question about how to measure unemployment. There's a desire to make this recovery a more inclusive one. Are you looking at more expansive unemployment rate other than U3? If yes, what would you consider for full employment?
So there has been a tremendous amount of attention, rightly so, paid to an inclusive economy, and I think that's terrific. But I don't think it just started. I want to go all the way back to the global financial crisis, and Janet Yellen, who I worked for at the start of that, and then I guess I always worked for a long time when she was the president of the San Francisco Fed, the vice chair, and then ultimately the chair. And in all those situations, she and other members of the FOMC were looking at a dashboard of economic indicators, recognizing that when dislocations of the size of the GFC come, and certainly of COVID, when they come into our economy, they don't just queue people up in the unemployment rate. People go out of the labor force. People may want to work, but they feel discouraged to even look. And people just get discouraged and leave altogether and wait for the economy to improve. Those were all things that were recognized. I myself worked on them, and we were looking at a dashboard of indicators back then. So I would love, if nothing else today, to eliminate the idea that we've just discovered that U3 is not a sufficient statistic to measure all the suffering and pain that goes on when an economy dislocates and we have a recession. So many other measures that are not even in U3, U4, U5, U6 are also important, like the labor force participation rate, the employment to population ratio. So we're using all of those all the time. And the really nice thing about our economy is that if we take care of people, Chair Powell said this the other day, and I thought it was just really well said. If we take care of the economy, and the people on the margins of our economy are able to participate, so many things take care of themselves. And we saw that in the last expansion. We had a sustained, long, historically long expansion with solid, even robust job growth, healthy GDP growth, inflation moving gradually back to our target, and people who had been left out of the economy year after year after year got a chance. Employers gave them a second look, they got jobs, and that's possible. That expansion in the latter years of it tells us what's possible. And so that's what running an inclusive economy means.
Great, thank you very much. So further on that line of an inclusive economy, could you speak to the effects that continued low rates having on different market participants. As an example, low rates may be having a negative effect on the budgets of seniors, forcing them to take more risk than they might otherwise. How do you think about that?
Sure. So, this is one of the challenges of, I mentioned earlier, we have a blunt tool. So we have a blunt tool, it's the interest rate. And when we lower interest rates, then what happens is mortgage interest rates go down, people can buy homes or refinance their homes, car loan rates go down, all the borrowing rates go down. But as borrowing rates go down, so does the return on savings, especially at banks, right? Because you're not getting the same interest rate on your deposits that you would otherwise get. And this particularly, as we've seen time and again, hurts the pocketbooks of seniors who are in a savings mode in their life as opposed to a borrowing mode in their life. And those are the balances we have to strike. But ultimately, what I know is this, and you can see this in the data, and you can witness it out in our economy, talking to members of the community. A good economy is good for everyone. It's good for seniors and it's good for younger people. So ultimately, these seniors are having to struggle with some of the facts that their deposit rates don't pay what they once did, but a strong economy benefits them. It's good for public services, it's good for tax revenues, which also get funneled to services that help the elderly, help the others in our society. So ultimately, a good economy is good for everyone. And our one blunt tool we have, which is interest rate policy, is doing whatever we can, doing our part to ensure that that occurs.
Great, thank you. So you've discussed the need for a prudential framework. What changes to the prudential framework do you see as necessary?
Well, I wouldn't want to call out a specific thing today as something that we should just implement. What I'm really calling for now is a broad discussion, a serious discussion of how we utilize things. So here's an example. We and it has been used in other countries, but not really in the United States in terms of exercising it, but a countercyclical capital buffer that says that during times of expansion, banks would hold more capital so that they're able to use that capital when a crisis or just a regular recession comes. And this time around, of course, banks were well capitalized coming into it, but we had to, the Board of Governors had to took the policy, and I agreed with it, to restrict dividend payments and share buybacks to preserve capital. I mean, one of the things you learn if you spend any time in a Federal Reserve system or regulator of any type is that the best capital banks have, the cheapest capital they have, is capital they already own. So it's this capital preservation that allows you to insure against risk. So I think a robust discussion of whether we could use that more and whether we should use that more, I think would be part of the prudential discussion that we should have. Another thing that I think is worth thinking about, but of course I'm not the regulator on these other entities, but I think it's really important for us as a society to think about the broader financial infrastructure and recognize that non-banks provide a lot of those supports. And that's good for both financial inclusion, but it also comes with risk to the financial system that we have to take into account. And so just broadening our sense of what we mean by prudential, and again, Federal Reserve wouldn't be the regulator here, but broadening what we mean by prudential protections to broader parts of the financial system is probably, I think it is a very important discussion that we need to have to weigh the trade-offs between the financial innovation that spurs growth, that we know historically pays huge dividends to an economy, against this idea that it's now less of a resilient infrastructure that's more prone to disruptions, which we just saw last March can be extremely costly. They're not free, even when the Federal Reserve comes back in with a backstop. Still, there's a lot of dislocation, a lot of concern, a lot of losses.
Great, thank you. So shifting gears a little bit, as cryptocurrencies continue to gain prominence in the economy, how is the Federal Reserve thinking about cryptocurrencies? How are they monitoring them? How is the Fed thinking about potential changes to monetary policy as a result?
So let's just back up for a minute, because I don't think every listener, every person I talk to doesn't have the same, I like to set facts first, or set ideas first, if you will. So here, there's cryptocurrency, honestly, depending on who you're talking to, is a giant bucket and digital currency, even so, even though it's a narrower definition, is a giant bucket to include everything in people's minds from Bitcoin all the way to would the Fed issue a digital currency, would other central banks issue digital currencies. And so I just take the moment to say, we're not talking about anything like Bitcoin and things. Those aren't even currencies, those are just assets that you bid on, and you can trade them, of course, but they're just an asset class that the value rises and falls depending on how many people want it versus the limited supply. So when we talk about digital currencies, we're just talking about another form of payment intermediation. And there, the Federal Reserve is, as Chair Powell and others have said, thinking about it. We have a couple of projects going on in the system, experiments. The Boston Fed is an example of that, where we're looking at some of the issues, because these aren't just obvious to do. There are, again, trade-offs, right? All the way, there's privacy, there's fraud and abuse, there's there's a convenience component, but then there's also all the way over a privacy component or a safety component. And if you think about all of those issues, what's really essential, and this is why I take it so seriously, is the Federal Reserve is charged with having a safe, stable, sound payment system. And we need to make sure that we're bringing those same values, those same attributes to whatever issues come up in terms of modernizing and creating digital currency. So right now, I would say in the learning process, in the discussion process, work being done, thinking about this, as Chair Powell has said, but it's too early to declare that we should do X, Y, or Z, because we haven't really been able to effectively weigh the risks and trade-offs along with the benefits and gains.
Great, thank you. One question came in about how different types of institutions are regulated and how that changes the incentives of different institutions. So banks, for example, are regulated in some other institutions, and that creates costs and incentives to avoid those costs by creating alternative types of institutions to avoid that bit of the regulatory framework. How can that inevitable problem be dealt with as we're rethinking how various markets work in light of the events of the last year?
Sure. No, I think that gets at the crux of what I was exploring in my opening remarks, and that is that we really need to think about our financial infrastructure, our financial system holistically. Because it's very similar to what I observed growing up in Missouri. If you build a levee in one place, but the water just goes and flows now more out where the levee stops, it flows all over the other groups, and because it's already been carried down and floods even larger, then you haven't solved the entire problem. So we need to think like that. We need to think holistically and say, what are the regulatory frameworks we need across all the financial intermediation tools so that we can ensure that we're not just driving risks from the banking sector to a non-banking sector, but then the risks are all the same. And this is why I started with this last resort. The title of the speech is actually Last Resort in a Changing Landscape. The idea that last resort is there is important, but it's also useful to remember that we're not just last resorting for the banking system, we're last resort for every part of the financial system that could get disrupted. So we need to look carefully at every part of the financial system to ensure that just what the question asker said doesn't occur. That we don't want to play, to take the phrase of a kid's game, we don't want to play whack-a-mole here, which is, you hit one area and another one pops up. You don't want to do that. You want to think more holistically. I think that's the call to action after the COVID crisis, is especially given the changing landscape we're in about low for long interest rates.
Great, thank you. We've got a couple questions in about the idea of the Federal Reserve providing backstops and whether that incentivizes improper risk taking in the markets, and whether it's wise for those backstops to be provided. What's your thinking on that?
Right. I think that's, in fact, I said exactly that in my speech. I completely agree. You've got to weigh these trade-offs, right? And if we simply said we're going to provide a backstop constantly and it's always there, then you could see that markets become more dependent on that, and it creates more risk than you're trying to eliminate risk, and it creates risk. So I think this is going to require a lot more careful study. We're going to have to think hard about it and really figure out how it interacts with these other sectors, how it, what's the trade-off. The thing that I think is really important is that if you think about money market and hedge funds and the structural funding issues that they have is an example. And I'm not picking on hedge funds and money market funds, but it's a useful exercise to think about, right? There's structural funding that is there, the architecture, and that works most of the time. But it doesn't typically price in the very bad state of the world, because the very bad state of the world is backstopped by the Federal Reserve. Because if you had to price in the very bad state of the world, it would look different. And so in the money market mutual funds, some discussions about swing pricing and changing even the redemption gates. Those are the things that I think would be important to think about as we think about the Federal Reserve's backstop. So it wouldn't be just us putting up, and this is completely my judgment, of course, but us simply setting up standing facilities, but then no other changes, would be exactly the concerns that the questioner raised. But it's about this holistic approach of, could we do these things in concert with other organizations that are regulatory bodies, regulatory agencies, fixing some of the other structural weaknesses. It's a composite, holistic approach that's going to make our financial system more resilient.
Great, thank you. So we have a question in on the recent fiscal stimulus, and the question is, how will the committee know when the stimulus provided by fiscal stimulus is something that's really creating sustained growth and is evidence of the economy improving and rebounding, versus what the questioner called a sugar rush, where perhaps there's an infusion and a momentary improvement, but maybe that improvement isn't sustained.
No, that's a really nice question. So let me just say how I'm sure we do it the same way many of you do it. But the first thing is, we have to recognize that the stimulus that was given by Congress so far is really building a bridge over a very deep hole. For many, many people who are receiving this stimulus, whether it's a PPP loan or a direct stimulus check or unemployment insurance, this is the thing that separated them from being destitute or losing some of their financial well-being. And so these things are critical to shoring us up so that we can get through COVID and well on our way to progress. And so we can just look at that and see how many people get to the other side of COVID and are ready to re-engage. And here I'm fairly optimistic, I will say, that as COVID we've been able to gain a little control over some of its spread by getting vaccinations, using the social distancing, et cetera, that people have come back out of their homes and they feel ready to spend. Look at the retail spending numbers today. They feel ready to spend, and quite to the contrary of all the predictions that we would never buy new clothes again, we would only wear sweatpants, they're out there buying stuff, and clothing was a big gain, and they're buying it in stores, not online. So I think we're seeing parts of normal activity start to reemerge, and I see that as good. That is not just, I use that as a signal this isn't simply a sugar rush, that in part this is really they have money, they're ready to go, and they have the momentum, and they're not so afraid. But I do think that where we have the potential to get ahead of ourselves, that's how I'm going to say it, is that with the fiscal stimulus, with the support of monetary policy, with the relaxation of social distancing controls, and just people being more open because now they're vaccinated, we're going to see in my judgment, a big rebound in the economy in the second half of this year. And that's going to be great. We're going to see jobless numbers come down. We're going to see more people be able to enter the labor market, spending I expect to rise, etc. And that's going to be that kind of temporary rebound that comes from people going from not able to do very much to able to be out there and re-engage quite a lot. And then the hard work will begin. I don't expect us to continue that robust path that I have forecast for the end of the year, just at that constantly high rate. I expect it to moderate somewhat, like we had last summer. People went out, they did things, and then we started to see a tapering off of growth to really good gains, but not fantastic gains, well before COVID started to rise back up again. So I think that's the way the dynamics of the economy are likely to work. Of course, I'm optimistic and always willing to have better information emerge, but there's also some downside risks here. So the big caution I have to everybody is, myself included, is let's not get too excited when we see a sequence of good numbers. Let's stay on the path of everybody who lost a job needs an opportunity to be able to get back into the labor market. And all of those new graduates who are being graduated during the crisis need an opportunity to get into the labor market in the first place. That's what a full recovery will look like. And if we do those things well, we're going to reach both our full employment and our price stability goals. And that's going to take some time.
Great, thank you. So we've got a couple questions about the Fed's new flexible average inflation targeting framework. And I know you've already described how the persistent undershooting of inflation that's been happening over recent time. But I think there's still some questions about, okay, but let's say we get on the other side of that. How will the committee in this framework ensure that inflation doesn't start taking off and is unable to be reined in like we saw in the 70s?
Yeah, so let's go back to the dynamics that created the 70s. So I think that's a good starting point. So the dynamics that created the 70s in part were that there were these we didn't have all the downward pressures on inflation that we face today. I'll just review them quickly. We have the lower neutral rate of interest. We're highly constrained by the effective lower bound, so we can't stimulate the economy quite as robustly and quickly as we'd like to, so it takes a longer time. And then we have, just globalization and pricing power is not something that I hear regularly. Most of my contacts, I talk to a lot of businesses in my community and across the country, and they all tell me they don't have a lot of pricing power because of the globalization. And some people have attributed to the Amazon effect. I tend to think it's more about globalization generally. You just don't have a lot of pricing power if you're an individual firm. And then we have a particularly different situation than we had back in the 70s. In the 70s, we had wages and prices linked very directly through cost of living adjustments. And if you just look at a chart, a correlation of wage growth and price growth, it's like correlated in the 70s and early 80s at 0.85, 0.9, just tremendous correlation. Prices would go up, wages would go up. Wages would go up, there'd be pass around to prices. And so you had this wage price spiral, cost push inflation. Those dynamics haven't been with us since the middle of the 80s and the Volcker disinflation. We just don't, the correlation between wage growth and price growth is not very big. It's very, very weak. And it's because there's a lot of wedges. There's a lot of room for wages to go up and prices not to react immediately. Businesses take it out of margins. They find cheaper ways to do other things. Capital investments have been falling in price. So all of these things matter. So those are the dynamics that I think are different. And then the commitment of the Federal Reserve, you saw this in our framework, we're committed to price stability and full employment. And we've defined full employment by saying we're going to offset shortfalls. That's how we're going to achieve our goals. It's a broad and inclusive goal. We're going to offset the shortfalls so we can make sure everybody who wants a job in the United States can get one. And then on the price stability, it's really average inflation of 2%. When you say average inflation of 2%, that means we're going to make sure that inflation can get up to that point, offsetting periods where inflation's below with periods when inflation would be moderately above for a sustained period. But nowhere in that document did it say we would let inflation run unbridled well above anything that people would be comfortable with. And I think that's the key, is the credibility's on both sides. I will offer that we have built our credibility over decades to ensure that inflation doesn't run away back like the 70s. And while it is fearful for everybody who was in a gas line or experienced those, I mean, I was part of that. I was young, but I was part of that, where it was a frightening time, right? But we're not in that situation now. And I don't want this tug of fear from the past to be the determinant of how we manage our future. I and others I know, we remain fully committed to ensuring that price stability is a goal we achieve on either side of the mandate.
Great, thank you. So I have one last question for you, if that's okay.
Of course.
What have been the main drivers behind the San Francisco Fed's research on environmental, social, and governance topics such as climate change and racial justice? How do you see the work on these topics intersecting with discussions around the independence of the Federal Reserve?
So there's only ever one driver for the work we do. We want to achieve and want to support achieving our congressionally mandated goals of full employment and price stability, and carry out our congressionally given roles of monetary policymakers promoting a healthy and stable economy in the dual mandates I just gave you, a healthy and sound payment system, and a healthy and sound financial system. So that's our core work. And then our job, and it's always been this way, is to ask what factors are affecting the economy exogenously that are going to affect all of those core business lines that we're responsible for, that Congress gave us. And climate risk and inequities are two things that directly affect those goals, those core responsibilities we've been given. Let me give you an example. So if you think about climate risk, which I think is really a clear one, we're not climate scientists, we're not climate change experts, we're not involved in any of the policies that want to mitigate climate change, but what we are is responsible for ensuring that the risks of severe weather events, which are just growing, and the impact that those have on the economy, the payment system, and the financial system, that we take account of those, just like the banks are taking account of them and other businesses take account of them. We need to supply cash. If there's a hurricane or a fire, we need to make sure that we have cash at the ready for individuals so that they can make exchanges and get the things they need to take care of themselves. So those are all extremely important to us, and making sure we do our role. And I would say equity, on the equity front, I mean, inequities in our society have been a bridle on our growth as an economy. And part of our job is to talk about how we achieve the potential output that our country can achieve today, but also pointing out the things in our economy that are affecting the speed at which we can grow tomorrow, and just making policymakers who have the remit to change those things aware that those things exist. So understanding that and making sure that we're talking about what we know just as part of the information set out there for other policymakers and ourselves is important. And it all comes back to a single thing. Every day we have a sign right as you enter our building, and when we come back to the building, we're all going to touch it, I think, which is our work touches every American and countless global citizens. And we take that to heart, and we do the work that we know is essential for us to carry out our mission for those goals.
Great, wonderful. Thank you so much. So I just want to thank you, President Daly, for joining us for this engaging and insightful event. And to the audience out there, I'd like to just mention, if you're interested in supporting further events like this and scholarships for worthy students in finance, please consider joining the Money Marketeers. Our website is moneymarketeers.org. Thank you very much, President Daly. Have a great day.
You too. Bye-bye.
Bye.